I love taking a property and making that transition and beautifying it and just creating at this point a community, changing that community.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. I have Jorge Abreu with me. And yes, I had to study how to say that last name correctly. It is true, because you guys know, my listeners know, I am not always good at that. I sometimes stumble across my own words.
You nailed it.
I got it right?
Yeah, you nailed it.
Hey, give me math, give me a contract. I am good. That is my area. That is my field. I do not have a problem with that. But give me English and grammar was never my strength. Science all day long. But so it's good to know your strengths and it's good to know your weaknesses. It can only make you a better investor if you can be settled with that, in my opinion. So let me tell you guys a little bit more about Jorge and why he's been invited to this show. So hold on a second. For those of you who are watching this on YouTube or on Roku TV, you'll be able to see his website here. So Jorge is Elevate Commercial Investment Group. Jorge Abreu is the co-founder and CEO of Elevate. He manages the properties before and after we close, communicates with the property managers, and makes sure everything is on track with the business plan, which we know how important that is. Jorge was born and raised in Miami, Florida, has a bachelor's degree in engineering. After college, he left corporate America and began a real estate career. He teamed up with Eric, and using his engineering background as a complement to Eric's marketing and Eric's background, built what is Elevate today. Jorge uses the engineering knowledge to manage all of the construction projects. With more than 12 years of real estate and construction experience, Jorge is second to none when it comes to elevating and renovating properties. Jorge currently has 125 million of assets under management, totaling 1,720 doors. And is that number still true, or has it increased?
No, that needs to be definitely updated. We're a little bit over 3,000 units now at 275 million under management.
Yeah, I was saying, I know you are both a GP on some of these and an LP on some of these. I heard that on one of your previous interviews. So why don't you tell us?
Yeah, those numbers are just general partnership numbers. I do also invest passively, but that's separate.
I just my opinion, Jorge, and I have been an active investor for, like I said, 30 years. And when I go to invest in a project, whether it's a syndicated project or even just lending out hard money to a project, I always like to hear what were people's tough stories, because that usually defines who they are and defines the success of me getting the success and percentage chance of me getting my money back. So Jorge, let's start with your background. So you started as an engineer, went from engineering to real estate. How did that happen?
Yeah, so similar to you, I'm really good with numbers and science and grammar, not so much. Without spell check, I'm pretty bad.
Okay.
But, so that led me to engineering, but at some point during college, I realized I didn't want to be an engineer. I really wanted to be a business owner, and started doing a lot of research and looking up successful individuals, and a lot of them had real estate investing. Somewhere in the path of them generating all this wealth was real estate investing. So I started getting educated on how to invest in real estate, and finally started doing some deals. At that point, I had graduated and I was working for UPS in the engineering department, but started doing enough deals where I finally quit my W-2 and started doing real estate full time. That was about 15 years ago now. Started with single family. We were doing wholesales. We had a rental portfolio, some small multifamily, and then a good percentage of fix and flips. We really liked transforming those properties. Ended up opening a construction company to bring that in-house. I got burned a couple of times by some contractors and decided let me control that piece a little bit more. And it helped. I mean, we got up to about maybe 40 to 50 flips a year, and then another 100 or so wholesales per year. However, I was starting to get a little burned out.
It's a lot. That's a lot of activity. That's a lot of chaos. Let's just call it what it is. That's a lot of chaos, and that's a lot of early rising, late nights, team management, numbers. People showing up, people not showing up, projects getting done on time, sometimes not getting done on time. It's a lot of chaos.
Yeah. It was working. I worked 24/7. I mean, my wife was in the business with me. It was literally just work. So around the same time, I was getting a little burned out on the transactional piece of it, going from one deal to the next. And at that point, I had decided to sell any rentals we had because I didn't like the managing of the properties. And at that scale,
tenants, tantrums, and toilets doesn't call to you. You don't get excited about the next time the toilet backs up, or the garbage disposal that gets broken, or the 50-cent faucet leak, faucet's leaking, and they're like, Go ahead.
More than anything, I'm too much of a nice guy, and when somebody gives me a sob story of why they can't pay rent, I'm too nice. So I got rid of those, and then at some point, about 4.5 years ago, I got introduced to multifamily syndications. Like before that, I thought the people that were buying these 100+ unit apartments had millions and millions of dollars to put down. And there was no way I could do that. But when I got introduced to the fact that I can bring in other investors with me and take these down, that kind of blew my mind. And I just started doing as much research and getting educated because, as you know, it's completely different from buying a single family and buying a 100+ unit apartment. Essentially, you're buying a business at that point versus just an individual property. So started looking for some deals and then was able to land some. At first, I was still doing some single family. And then eventually, after a couple of deals in the multifamily, I decided to sell all the single family we had and stop looking for any more single family and 100% focused on multifamily. And that was really a turning point. Once I did that, it really started taking off.
So you prefer the multifamily over the single family, and why do you prefer it?
Yeah, I 100% I do. The main reason is, there's a lot of reasons, but
no, tell me. I probably can guess at it, but I want my listeners to hear it from the mouth of the expert, right? You own 2,000 doors, or you're involved in over 2,000 doors for yourself and for your investors. You have some really good experience as to why your opinion is meaningful.
Yeah. So one is the economy of scales within one building. I continue to try to scale my business with the residential, and just to get to the volume of, let's say, 100, right? To get 100 single family homes versus an apartment that's got 100 units, a lot easier, just one transaction. So that was one. The tax benefits alone from investing in some of these properties and the depreciation you can take is a game changer within itself. And then just the overall industry within real estate. It's a different sector. Everybody's out to help each other. It's very, we team up with other investors to take down some of these apartments, especially the larger ones. So a lot of teamwork, and that was kind of a surprise. I didn't know that going in, but yeah.
When you first went in, were you trying to do it yourself with your own private investors, or were you did you end up partnering early on?
At first, I that was the initial thought, but then, once I started digging in a little bit more, just getting a loan for, commercial loan for a multifamily, one of the things they look at is experience. So I knew at that point I was gonna have to bring somebody in. And then I wasn't really used to raising equity. On the single family, we had a couple investors, like just a couple, and they would invest in all our deals or fund our deals. So at first I looked for a partner that could bring that experience and raising the equity, teamed up with them on a couple deals, and now we can pretty much handle every aspect.
So when did you and Eric start joining together? Was that?
We started together with the single family. So it's been a long time.
It was a long time. It's been a long time. So he's been on the learning curve with you.
Yes.
So tell me, what is your particular love in multifamily? Multifamily is actually a relatively large market. There's 5 doors and above, right? There is anywhere inside of the United States. There's primary markets, secondary markets, and tertiary markets. What's your love? What do you guys try? What do you guys like to do?
Yeah, I mean, our bread and butter is C-class workforce housing. We do have some B-class as well. And then in main markets and also some sub markets off of the mains. And I really just love, and we talked about this before we even got on, I love taking a property and making that transition and beautifying it and just creating, at this point, a community, changing that community. So yeah, I really enjoy that transformation.
That making a community is a piece of turning a property around, and it's a piece that not everybody pays attention to. I had a client who was looking to purchase a property, and it was like I just Googled. Wasn't at the property. I just Googled it from when you do the Google virtual walk, right? These days. When I started in real estate 30 years ago, I had to pull out the Thomas Guide, photocopy the pages, tape it together, pull out the MLS list, put all my little dots. That's how I used to have to comp a property when I started. Okay. So that was 35 years ago, literally. Now I just do Google Walk. I'm like, oh, type in the address, walk the street. There we go. I'm like, this is so much better. But the point being, so we were doing a Google Walk onto this property. I'm like, the outside of the property looked scary. You're just walking into it. It's like it was the end of a road at the end of it, not even a cul-de-sac, just like the end of this road, turned off to the right. The building looked like it was off in the distance. The parking lot was barren and empty. All you had was a bunch of lines and some dead trees. And I'm like, yeah, this one really needs some help. And the primary thing it needed was a culture change, right? The culture change.
You would buy that. You just described a great property.
Oh man, I wish I knew its address. I should have sent it over to you guys, because that's what that property needed. It wasn't so much the interiors. Yes, you need to work on the interiors and we can talk all about the numbers, since you like numbers and that whole, strata of it. But the culture change can be just as much of a value add. So tell me more about how you guys do that.
It's harder to put a number on that sometimes, and some people don't realize that. But I mean, if you create a real community where everybody wants to live there and wants to stay there, just take the turnover cost and having to get a new tenant in, and there's a lot of savings in that alone.
Vacancy factor. There's the actual tenant leaving and the amount of time the unit's vacant. There's the make ready on the unit. There's the concessions when you try to get that tenant in there. And once you calculate that, that's generally about 3 months worth of rent, just in and among those costs by itself. And then you have to go, well, how much am I really going to get in increasing rents? Is it going to be worth the 3 months I've just lost? Right? Just in the sheer math. So yes, sorry. Think about tenant turnover, increase loyalty, change culture. You can have it back now.
Yeah, I mean, I'm not sure where else to take it from there, but yes, I love.
What does your crew try to do to create culture change in the C-class buildings? Because that is the C-class and D-class buildings in particular are the ones that are mostly in the need of that culture change, right? You can have
right off the bat, they begin to see the changes and the fact that we're coming in and we're making renovations. We usually start on the exteriors. We do some pretty dramatic things like we love painting the brick. So if there's brick, we'll come in and we'll paint it and we'll give it a real modern look. So they start seeing that, and then we always push to start having community events. So they'll start, seeing events happening every month. And then obviously we start going into the interiors and the way we take care of our work orders. Yeah, I mean, we start getting lots of referrals at that point, and you can see the change being made.
When you can get tenants to refer, when you can get quality tenants to refer quality tenants, is when you start truly getting a cohesiveness to a community. I've had both happen. I've had difficult tenants refer difficult tenants.
Yeah. Well, thank you.
And I've had quality tenants refer quality tenants, and I prefer quality tenants referring quality tenants. So the culture changed. So let's talk a little bit about the math. So what is it that you guys are looking for? How do you know this is the right thing to purchase in order to take it through your system?
We look for true value add components where we can force that appreciation. And I say true value add because that term has gotten thrown around so much in the past couple of years that a broker just calls everything a value add.
Right.
So when I say a true value add, I'm talking about something that's under market rents, usually at least 100. Most of ours are on average 200 to 300 under market rent, where we can come in and like I said, fix up the exterior. Usually there's going to be a good amount of deferred maintenance if the rents are that much under market. Take care of that deferred maintenance, start fixing up the interiors, and then start raising the rents. Depending on who our resident base is, a lot of the times they can make that increase, and stay in there. And sometimes we have to reposition some of the tenant base.
I have found in the Midwest that they can be much more sensitive to $20 or $50 than I find in my LA-based properties. That just, the rent's less, $20 to $50 is a bigger percentage of increase in their actual rent number and their cost of living. And they're much more sensitive to that price point. And it's harder for me to make up a turnover, right? That whole 3 months of loss, like a system. An HVAC system is expensive, whether it's expensive in the Midwest or expensive in LA, it's still an expensive system. And if I have to replace an HVAC system, a capital improvement on these properties, my Midwest properties are more sensitive to that. It costs me more months of profit to replace an HVAC system than it does in some of my LA properties. Just pure numbers, just the pure difference of $1,200 versus, $1,200 in rent versus $3,500 in rent.
Makes sense.
Right. So, so how do you guys then, you said true value add, right? So we need $100 or more of a discount in rent, preferably 200 to 300 underneath. There needs to be deferred maintenance so you guys can actually fix something and make it truly better. Mm-hmm. What are you hoping for at the end of the day? What's your target?
We structure our deals differently from deal to deal, but usually the heavier value add ones, our goal is usually to get them up and running within our bridge loan terms, which is going to be 2 or 3 years. So get them to that stabilized rent, and then turn around, refi, cash out, give our investors either all their capital back or a good portion of it at that point. And then on those, the term that we hold them for, if we're able to return a good portion or all of it back to our investors, is we like to hold those a little bit longer because we don't have the pressure from the investor wanting their capital back. So we'll hold a good cash flowing property for however long at that point. And then there's somewhere, some of our B class, we're not able to add that much value where we can take out a big chunk of on the refi, or maybe we go in with an agency and we're just looking to get it stabilized to where it's getting our investors, an 8 to 10% at least cash on cash. And then usually our terms are, we'll look to sell in year 4 or 5 on those.
Okay. Yeah, that's what I was going to ask was when you bring your investors in, it sounds like it probably varies from building to building, but in general, is your structure to get them out in 5 years or to keep them? Because it sounds like you intend or desire to try to keep them.
keep them if we're able to return a good portion of the capital back on the refi. Yeah.
Okay, and your investors are like, yeah, this, because, you know, if I put 40,000 into a deal, like right now, I'm putting 40,000 into a deal. They're intending to return to me about 50% of that 40,000 because they've already been able to force equity during the escrow period. They're intending to return that to me in a refinance in 2 to 3 years. And then I'll get a 7% cash on cash. But once they return 20% back to me, or if return 20,000 of my 40,000 back to me, my 7 just became 14. I'm like, no, I like that.
Right.
As an investor,
yeah.
right? And so what you're saying is that you're offering them a similar deal. Like, we're going to keep you in this deal for 10 years, 15 years, or at least until we as a group decide to sell. But once we refinance the building, therefore get back most of your capital or a good chunk of it. Even 50% can be incredibly meaningful.
Yeah, I mean, right now we've got one closing in 30 days. The refi is closing in 30 days. That one, we're returning 100% of the capital back plus more. And at that point, their returns are infinite, right? You know,
That's
why
right.
wouldn't they stay into the deal longer? So yeah.
Yeah, the fact that I get to remain, I get my cash out and I get to remain an owner means there's no reason why I shouldn't continue to hold it in my portfolio as an investor. Unless it's like one of those deals where we said it's a B grade deal and it's more about, yeah, I want to be positioned and then I want, because my bump above this 5-6% cash on cash you're giving me really is when the building sells.
Mm-hmm.
That's when I start getting into my 10% or double digit returns. So,
right.
Do you guys do small buildings? Do you guys do large buildings? I mean, how do you ensure that you really have management over these buildings? I mean,
we like to do 100+ units, which allows us to staff on site appropriately. Where I've done smaller. My first one was 37 units, and I feel like I put more work into that one than I did any other ones because of the size. And you've got to be more hands-on when it's less units.
So when you say you can stack it correctly, why don't you, and I know what you mean, but why don't you explain it to the listeners and the viewers, like, what do you mean by being able to get good control over a 100-unit building and how that's easier?
Yeah, I mean, you want to be able to staff on site, right? You want to have a manager, you want to have a maintenance, possibly a leasing officer or whatever you want to call them. That just makes the day-to-day of it a lot easier. You know, you've got to manage them instead of managing the property in a sense.
Which is why having 100 units is actually less of your time than having the 38 units.
Correct.
Because you actually have somebody who's like, this is your job, this is your baby, you're going to take care of it. It's 100 units. You'll always have something empty, or at least a show unit. You can always show somebody. You should be able to turn stuff over in a very short period of time. And this is what you get to do all day long. So in theory, they should really be able to wrap their arms around it and take ownership on it, both financially and, like we said, culturally. Yeah.
And I don't want anybody to think that it's easy either, right? You still got to manage them and you got to make sure you're hitting your numbers and whatnot, but it's easier, I think, than having to do more of the daily activities.
Well, and usually the staff that you hire in 100 to 150 unit, you're paying them more. Right. They truly are a 40-hour-a-week employee, right? It's like I've owned smaller units. I'm a mom and pop investor, right? I've owned small. I will have on-site managers, but they usually have a part-time job or they work somewhere else, and I'm not really getting 100% of their attention, and they're not used to running QuickBooks. They're not used to running the numbers, not used to being accountable to some weekly performance check or monthly performance return of like, hey, did the building hit its net income targets? And were you able to get that extra $50 out of that unit because that level of sophistication of truly optimizing a performance on an investment doesn't usually exist in 50 units or less.
Correct.
So just my take on it. But again, I've only owned 350 units at the height of my investment, and you own much more than I do. So again, I look for your expertise in being able to manage that. So
get you buy some other properties.
Say that again, what?
Let's get you buying some larger properties.
I need to be buying larger properties. Clearly, I mean, that's clearly what I've missed, right? Is that I've been buying mom and pop properties with tennis tantrums and toilets. The truth is, right now I own 4 doors. Right now I own 4 doors. That's my whole active investment portfolio. The rest of it is all some version of passive at this point.
I mean, that's good too, for sure.
It's helpful if I'm trying to have peace of mind and I don't want to do a lot of tennis tantrums and toilets. And those 4 doors are short-term rentals, right? So I don't even have the deferred maintenance problems and I have a short-term rental agent who takes care of it and blah, blah, blah. So there you go. I turned right at one point. That's it. But again, it might have been because I wasn't owning units that were 100 doors or more, and therefore managing the managers, which I'm better at managing the managers than I am at managing the tennis tantrums and toilets, truth be told.
Yeah, yeah, I learned that quick. I wasn't built for that.
So it looks like you're capable of offering a solid return to your investors and both managing the sort of 5-year hold as well as the multi-year hold, which probably explains how you've managed to get 3,000 units. How has COVID been for you guys, given that you had so many doors through what was a tough time?
So obviously interesting time, right? And then nobody was expecting it. It did allow us to really zone in on our management and asset management and also property management. Overall, as a portfolio, we did really well on collections and just keeping things going, right? And being able to lease throughout COVID. We kept our staff on site and working for the most part. We did have one property that we were deep into the value add right when COVID hit, right? And it wasn't the right time to try to raise rents. So that one we did have to make some adjustments. But we're able to work through it. We're able to increase the occupancy to where we never even thought we could get it. And thanks to rental relief programs, the collections was amazing as well. So we're now getting ready to sell that deal actually, and do amazing on it sooner than we thought. So I don't know, it's weird. Like COVID caused that, and actually gave us that opportunity to exit on it early, because now coming out of COVID, the market has just gone insane.
The market is going insane. The multi-unit market has been, in my opinion, been insane for a while. When cap rates get less than 5,
yep,
I start getting hesitant about buying into multi-units. I own multi-units, probably 2 decades ago was when I started buying into them, and I was used to a 7 cap. Where my cap rate was clearly greater than my interest rate, and I was going to be able to make a cash on cash return, and that's what I thought they were for. And now here in Southern California, at least, that's not so much the investment style. You're lucky if you can buy a multi-unit at neutral, right? So that it's effectively cash flow neutral. And again, these are mom and pops, more mom and pop units versus the Midwestern units, which you can still get 100 doors and still get some pretty solid cash flow off of them.
Yeah, I mean, look, there's investors out there buying deals that I don't see the value add component to it, and they're valuing they're going in cap rate is 4, maybe even less than 4% on some of this.
Mm-hmm.
Those type of deals, I look at it, I'm just like, I've been through the 2006, 2007 downturn, and I don't know. I just look at those deals and I think, this is going to give at some point. It's not going to be. I don't think it's going to be anywhere near as crazy as what happened back then. But history, points to that. There's going to be. It's a market, cycle,
market.
right?
It's a
gonna be
cyclical
that
market.
downturn at some
It's
point.
always been cyclical. We know this. It's never
Yeah.
not been cyclical. So
Yeah.
go ahead, George.
So people shouldn't get surprised, but yet it seems like they always do. You know, things start getting easier and easier to buy properties, which right now it's pretty darn easy. So yeah, I mean, we go through a lot of underwriting, and we spend a lot of time looking for deals that we still feel we can force that appreciation. There's still value to add. And to me, that's just very important. I also look at the price per door. I don't just pay attention to what the cap rate is saying, and you know, I want to know what I'm paying for per door, and that my exit makes sense with the per door value, which a lot of this stuff doesn't.
No, it doesn't these days. It's been for a while. It's been basically, I mean, multi-units was the first to recover seemed to me that multi-units was the first to recover in the 2007-8 downturn. And then single families followed after that. And a lot of it was, I was hearing investors say, hey, if people are going to be kicked out of their houses, people are going to need to rent. Let's buy multi-units. And it was like a flight to safety for investors. And it continues to be sort of this, I don't know, because a blue chip investment, right? Like we want to buy a multi-unit because it's going to be stabilized over a long period of time. But it, like you said, I'm with you, which is ultimately it is cyclical, and ultimately the cap rate has to stay above the interest rate, and the interest, otherwise, you know, you're running a negative. You're literally running starting to get into a negative return.
Right. I agree 100%.
All right, so George, let me ask you this question. You just said that you have been through the downturn of 2007 and 8. I've been through the downturn of 2007 and 8. That was a huge learning opportunity for me of really self-accountability on my desire to be a professional investor or not, or to not be a professional investor or not anymore. George, real estate can be great. We talked about how it can really get you long-term value add, how your investors can be taken care of. They can double their returns. They can get infinite returns, but it also can be a very bad mistress. Every once in a while, your backside gets handed to you. So share with us one of your stories about when real estate wasn't great.
Yeah. So look, I think in any business, you've got to be able to be flexible and adjust to the market. I think, you know, we have that in history too. If you look back to businesses that were not able to do that, I don't know, maybe a Toys R Us, or I know there's some electronic companies that have gone out that just didn't catch on to, hey, you got to sell stuff online, kind of.
Yeah.
Right. So when that happened, luckily we didn't have a large portfolio at that point, and it was pretty easy. Like we escaped, is what I want to say, right? We didn't own a lot of properties at that. This is when I was in South Florida. In South Florida, it literally felt like it was from one day to the next. Somebody shut the light off, and it was crazy.
Yeah.
But we couldn't keep doing what we were doing. So I mean, I did have that moment that you just talked about. I did have to look at myself and go, okay, what am I gonna do? Am I done in real estate? Do I need to go back to engineering? What?
Yes.
In South Florida, you couldn't touch real estate. Like it was literally going down daily. Similar, I'm sure, to California and pretty much the two coasts. So that's when I made a move. You know, I now live in Dallas, and I looked at different markets, and we pinpointed that Dallas-Fort Worth was still very stable compared to other markets, and that we could go in there and start doing some business. We did start picking up more rentals at that point.
Okay.
Felt like the safer bet versus trying to fix and flip a property at that point. And you know, it turned out that little adjustment right there was great, because the second the market started going right back up, like I said, I didn't like having those rentals. We fixed them up and sold them for good profits.
Yes.
And yeah, I mean, that was definitely a turning point. You know, I've had a couple others Not sure if you want me to go into another one, but
You can go into all you want to, but you described what happened. Let me ask you this question before you go into your next one. What did you learn from it, and how did you grow up as an investor?
I learned from it kind of what I said, that you do need to you need to be able to adjust with the market.
Okay.
And learn that several times through that same cycle.
Right.
We continue to adjust and adjust and adjust. What type of real estate we were doing, how, were we wholesaling more? Were we doing the rentals? We adjusted that a ton throughout the cycle.
Okay.
So I feel like I learned that, and then I also learned, like I spoke about before, the importance of the purchase. Like, you need a purchase right.
Okay.
I know in single family that's a big thing, and everybody talks about that. You make your money when you buy. Right. In multifamily, they don't so much, and I get it because it's very different. But I still think that component is there, and I think that's what allows me to have some safer investments for my investors when that market downturn does come.
Okay, so the capacity to adjust, because I would say the adjusting you described to me almost seemed lucky, but it sounded like it was actually much more conscious. Like, this isn't working in Florida. We need to not do this anymore. I need to figure out what is going to work. Yeah,
no, I mean, there was a lot of analyzing and looking at numbers, and for sure, I mean, maybe a little bit of luck, but.
Okay, well, it sounds like your luck was better than, sounds like your analyzing was better than mine. So good on you. I mean, because it really is
I definitely did not know that Dallas was going to become what it's become. I knew it was a good market, but I mean, it's crazy now.
It is. Well, it's been crazy for a lot of, from my opinion, it's been crazy for a lot of years, and therefore it probably, but it made sense. Like you said, Florida was just a mess. I mean, Florida, Las Vegas were probably the worst hit. Las Vegas, over here on our coast. And some of Las Vegas lost anywhere from 65 to 80% of its value, depending upon what you're holding. I don't know about you, but that seems like a significant loss to me. And I know Florida was seeing significant hits as well. Yeah. And so it was intentional. So what were you, I guess my question is you were flipping in Florida and you went into rentals in Dallas. Is that effectively what happened?
Pretty much, yeah.
Pretty much. How were you able to get out of your flips in Florida?
This is probably the lucky part. I mean, we had literally sold all of them, but one that we ended up doing a seller finance on, and that's how we got out of it. We did a seller finance piece to it. But we had just sold all our other ones.
So you literally had actually sold all the rentals but one. Good job.
Well, no rentals. We were doing fix and flips at that point.
Flips. Yeah. So all of them.
But we were doing several at a time. It wasn't like we would do one at a time. So yeah, we got lucky.
Either lucky or you're a very good engineer.
We'll go with that one.
We'll go with that one. Not a problem. You're an awesome engineer. You nailed it. So you're using real estate for your own personal, to break through to your own personal financial freedom. I know that you have some of your own holdings as well, as you're a general partner on a lot of different properties. Why use, given that we've now seen real estate can be incredibly dynamic, why use real estate to break through to your personal financial freedom? And what does financial freedom mean to you?
So to me, financial freedom is time, gaining back the time with my family, gaining back the freedom to pretty much spend my time with them. Financial freedom means to me is being able to do what I want with my time and really gain back time. A lot of people sometimes say that money's not important. To me, that's not true, because what money gets me is time. So that's why I'm trying to build the wealth and to also leave something for my children and their children. So more of that legacy type wealth, but at the same time, allow me to decide where I want to spend my time. And to me, family is everything. So, there's not one special event for my children's that I do not show up and I'm there.
I was going to say, being a good dad is a legacy to leave. And I love that you choose that.
Sure.
I'm going to go ahead and wrap this up. Thank you so much. This is Christina Suter on the Real Estate Breakthrough Show. I've had a wonderful time interviewing Jorge Abreu from Elevate Capital Investment Group. How do people get a hold of you if they're looking for that possibility of an infinite return on a multi-unit investment?
So we've got a ton of information on our website, which is elevatecig.com. They can also shoot me an email if they like, Jorge or George at elevatecig.com. There you go. Awesome. Thank
you, George, for your time. Christina Suter with Real Estate Breakthrough Show. We so appreciate tuning in next week for our next show. We're on iHeartRadio, iTunes, and Spotify, as well as Roku TV, as well as YouTube. If you have had an opportunity to invest in an investment where you were able to hold it long-term and feel like you got infinite returns, why don't you put a comment down below on what that took for you as an investor? Was it luck, or were you able to calculate it out? This is Christina Suter. Thank you so much.